Hey everyone, and welcome to Talk ETFs. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Today's topic is liquid alternatives. My guest today, Sal Bruno, is the Chief Investment Officer at IndexIQ, and he says that alternatives can help insulate a portfolio during times of market stress. So stay tuned to learn more about that. Sal, welcome to the show.
Great to be here. Thanks for having me.
What's your take on the current macro environment? Are we out of the woods when it comes to inflation and higher interest rates?
I think that's a great question and a great lead into this conversation, because I think what it highlights is you're thinking about what are the risks that are out there. Obviously, there has been interest rate hike risks, and perhaps we're at the later stages or the end of that. Given the comments from Chair Powell at the last meeting, perhaps they are done or at least on pause with that. Inflation still remains persistently high, well above their 2% targets. I think there's probably more work to do. The question is, are they going to let the rate hikes that they've already put in place do the work, and maybe some credit tightening do some of the additional work, or will interest rate hikes have to come back on the table later in the year? I think nobody knows the answer to that. I think there are also other things going on in the world that are potentially causing volatility in the marketplace. Obviously, the Ukraine-Russia crisis is in its second year. Ukraine's been talking about a spring offensive. And I think that has a potential to add volatility. And then, of course, we have the debt ceiling issue going on in the States. And as we're speaking today, it's, the negotiators have basically left the table, uncertain if they will resume over the weekend or not. So that continues to be an overhang. So I think the question is, there are a lot of risks and uncertainty out there. How they will play out, I don't think anybody really knows exactly.
Now let's talk about liquid alternatives. But before we get into specific strategies, I'd love it, Sal, if you could tell us what that term even means.
The way we think about alternatives is that they have an alternative source of return than a traditional asset class. So traditional asset classes like stocks, you expect, you're going to make money when the stock market goes up. Bonds, you will make money from the coupon, and potentially if interest rates fall, you can make some money on the principal as well. Alternatives have different risks that are driving their return. So if it's something like a merger arbitrage, you are owning equities, but you're trying to make money on the potential completion of announced deals, and you put some hedges in place to try to limit some of the risk. But it's basically a different source of risk. It's not whether the market goes up or down, it's whether the deal's complete. So it's an alternative risk than just the direction of the market. Same could be true for managed futures, where you're taking long and short positions in commodities, currencies, maybe using government bond futures or equity futures. And by putting those together, you're creating a very differentiated return profile and risk profile than just being long only equities or bonds or commodities, currencies, et cetera. So when we think about alternatives, we think about this being driven by something other than just kind of a long position in a traditional alternative and traditional asset class. Where the liquid piece comes in is a lot of alternative strategies have traditionally been in limited partnerships, hedge fund type structures that have less liquidity than an exchange traded product would necessarily provide. So what we're talking about here is allowing access to many of those hedge fund or alternative type strategies in a vehicle where you have daily, even intraday liquidity in the case of exchange traded funds.
You talk about how there's different alternative strategies and how they all perform differently. Can you talk about this idea, how it's important to diversify your diversifiers?
When we think about diversification, I think of it at kind of three different levels, and I think it makes sense to have diversification at all these levels. It really fortresses your portfolio. The first is the traditional diversification. So you think about people own bonds to diversify their stocks, or they might own international stocks to diversify some of their U.S. equities, and that can work, and it has merit to doing that, or maybe owning an alternative strategy as a diversifier. That did not work great in 2022, where the U.S. equity market was down 18% approximately for the year. International was down around 14%. Bonds were down about 13%. So yes, you got some diversification, but it wasn't tremendous. Alts, on the other hand, depending upon which strategy we're looking at, ranged anywhere from -8%. If you were looking at multi-strat, merger arb was actually slightly positive for the year, in a year where the equity markets were largely negative. And there's a strategy like a managed futures was actually up about 7%. And the returns I'm quoting for these particular strategies are all the Barclay Hedge Fund Index returns for those particular strategies. So we're not talking about individual funds. They're published and well known as a hedge fund index provider. So what we're really getting at is, even within alternatives, there's a range of exposures or diversification that you can get. And, if you were in a multi-strat, you may not have been as happy as you would have been if you were in a managed futures product in 2022. But that doesn't always hold. That 2022 is a very specific year. And so the point of what we're trying to talk about here, diversifying your diversifiers, is we think it makes sense because every crisis is different. And whether it's an equity crisis or a credit crisis or a rate crisis, each one's different, and we can expect different alternative strategies to perform differently. And so we think diversifying across those makes a whole lot of sense.
And are there any specific ETFs investors can use to employ these strategies?
Obviously, as IndexIQ is one of the leaders in liquid alternatives, we have some strategies, and we have a strategy in the multi-strat space. QAI is the ticker. It's been out since early 2009. That covers gives you exposure to multi-strat hedge funds. We also have a merger arbitrage ETF that came out later in 2009, so significant track record. The ticker on that one is MNA. On the managed futures front, there are a number of them. Probably the biggest and most well-known is DBMF, which is a managed future strategy. Not our strategy, but it took in a significant amount of assets last year. There are others too in the merger arb space as well as in the managed future space, which kind of gets to the third point of diversification of kind of even if you're diversifying across different strategies, so you want to get some merger arb and some multi-strat and some managed futures, even within that, you may want to own a couple of different merger arb ETFs. And there are a bunch that are out there because the correlation is actually fairly low. The correlation of the merger arb ETFs are kind of 0.3 to 0.4 because each strategy is run a little bit differently. Different hedging, different selection criteria, different holding criteria. Some are active, some are passive. The same is true in managed futures. Some may invest in equities, some may only do currencies and commodities. So it's hard to say I did the analysis on just the Barclay Hedge Fund Index, but there's wide variation on the managers there. So you can even diversify some of picking the wrong manager by owning a bunch of managers within a particular strategy.
Finally, before I let you go, Sal, is there anything else you want to add? Maybe you could let our listeners know where they can find that blog post that you recently wrote about liquid alts.
If anybody wants to read the blog that contains all the information that we were talking about, you can go to NewYorkLifeInvestments.com. There's a section on insights. Make sure you select your financial advisor. And if you scroll down, you can find the paper called Are You Ready for the Next Crisis?
Sal, it's been an absolute pleasure having you on the show. Thanks for your time.
Thanks, Sumit.